Wish you all a very happy new year and wish that 2026 brings all the health and happiness that you want. Let's come to the economy side. If you look at global economy, there is a profound change happening whereby BRICS nations, like led by China, is now on a purchasing power parity basis having more GDP than G7 nations. US-China relationship will shape the future. The first option for US is to treat China as an adversary, which means they'll have to invest trillions of dollars to get supply chain independence from China. Today, US is dependent on China for rare earths, metals. But to get this trillions of dollars, US will have to print a lot of money that could create inflation, or they'll have to shift money by sacrificing return on equity for long-term investment. This could create structural bear market, and since half of US household wealth is invested in stock market, it could create consumer pain. The option 3 is a Plaza Accord kind of Mar-a-Lago Accord. Under Plaza Accord, US forced Japan to appreciate its currency. Yen appreciated from 300 yen to a dollar to almost 70 yen to a dollar. And that took away Japan's export competitiveness. But who will convince China to appreciate its currency? The second option is where US says China is not a competitor, is a competitor, not an adversary. And they divide the world in their sphere of influence. Venezuela is mine, Taiwan is yours. As of today, it looks like that US is pursuing option 2, though it is difficult to say with conviction. Globally, G7 economies' debt continues to rise and remain at elevated level of almost 130% of GDP. Central banks around the world cut interest rates in 24 and 25. Now they are expected to cut interest rates, but it will be far lower than what was last year. Within countries, there are advanced economies where Japan is raising rates, but majority of advanced countries, including US, are cutting rates. On the emerging market side, again, most of the countries are looking to cut interest rates. So overall, there will be loose monetary policy in both advanced nations as well as emerging nations. Global GDP growth will remain strong, but still below pre-pandemic average growth. Overall, global equities have started doing well, with profitability inching up and analysts revising profit estimates on the higher side. The key risks for global market remains the same. Will AI be a bubble? How will US and China cooperate or contradict each other? Whether inflation will come back? And is de-dollarization a phenomena to watch out for? Japanese 10-year bond now has crossed 2%. 30-year bond is above 3%. That could have consequences of yen carry trade reversal for the world. Coming to Chinese economy, the government continues to provide fiscal impulse. They continue to support economy. While it's a communist country with no election, they continue to have their own welfare schemes, rivalry programs. The household consumption has remained subdued despite overall economic growth. This is partially driven by financial repression, where Chinese citizens don't get enough return on their deposits. China has invested heavily on manufacturing dominance, but by creating so much of capacity, now they are not able to utilize it fully. Overall trend in capacity utilization is declining because capacities are coming faster than the demand. Undoubtedly, what China has achieved is truly amazing. In 2020, they were selling less than a million, or they were exporting less than a million motor cars. And there were countries from Korea to Japan to Germany to US ahead of them. And in just about 6 years, China has crossed all these countries in export of automobiles. And now they are exporting 6 million automobiles. The scale which China has achieved in automobiles is truly amazing. Having invested so much into capacity buildup, now the manufacturing capex has started declining. This large manufacturing capacity is used for exports, and that is one of the biggest driver for Chinese economy. The Chinese stock markets last 2 years have done very well, up about 60%, but they are still trading at a level where they were trading 17 years before. In this period, they have gone up 5 times and fallen 5 times. Will China be lucky 6th time? If Chinese market goes up, less money will come to India. If Chinese market falls, more money will come to India. Coming to US economy, the tariffs does bring money to American government. Their third quarter GDP came at 4.3%, way ahead of expectation. This was driven by domestic demand as well as fixed business investment. The fixed business investment was driven by artificial intelligence investment. The hyperscalers really put a lot of money for AI, and that kind of pushed up American growth. Notwithstanding that spectacular growth, America runs debt of $38 trillion. The unemployment rate has started inching up. It's not as high as it was during COVID time, but it has started inching up and crossed 4.5%. Our interest in America remains. When dollar depreciates, money go out of America. Now, dollar has depreciated 12% last year, but people have brought money into America of almost $1.6 trillion. This is contradictory to historical example. Last year, emerging market index outperformed American stock market. Will foreigner take money out of America? They have close to $30 trillion in America. With 12% depreciation of dollar, they have lost close to $3.6 trillion. Will there be more losses, or will people start taking money out? The artificial intelligence investment undoubtedly has supported American economy, and it has also created difference of opinion. One side saying AI will reduce inflation, other side is saying AI will reduce employment. How will these two factors play? We'll have to see. In that contradictory global backdrop, Indian economy has done reasonably well. Numbers are coming by and large as per expectation. The government is stimulating domestic economy by putting money in the pockets of consumers. The latest addition is labor code implementation, which is putting money in the pockets of employees. However, the tariff negotiation with US are not getting concluded, and tariff deal continues to remain elusive. In fact, one of the senators has put a proposal which authorizes President Trump to levy 500% tariff on countries which are importing Russian crude. Will they apply universally or will they apply selectively? Your guess is as good as mine. The IIP numbers in November came well ahead of expectation at 6.7%. But do remember, October numbers were quite dismal. So if I average October and November, there's nothing to cheer about. High frequency indicators are confirming that consumption in November has remained strong, and the impetus given by GST tax cuts continue as we move forward. The effective jump in US tariff is about 2% to 17%. That's about 8.5 times, one of the highest in the peer group. However, on an overall basis, our percentage tariff as a percentage of total exports, total imports into US is reasonably on the lower side at 17%. The sectors which are getting hurt are labor dominated, labor intensive, like textiles, aquaculture, gem and jewelry, and handicraft. Despite tariff, September to November 3-month period, overall exports to US has remained flat. It was up 18%, so there was some front loading here. But despite levy of 50% tariff on some goods, overall exports to US has remained stagnant. It hasn't fallen. Lot of credit goes to Apple. This year, their mobile handset export will cross $50 billion. There is a hit on textiles, aquaculture, gem and jewelry, handicraft. But to a great extent, Apple is helping that close. In FY26, our challenge is not on the trade deficit side. That's reasonable. It's the capital account where net foreign direct investment has become very, very low. And the outflows on capital account through remittance continues. This will be the second year in running where BOP will be negative. That is, current account deficit will not be funded by global investors. The net foreign direct investment has come down dramatically as companies like LG, Hyundai, Whirlpool, Prudential have taken money out. In order to contain rupee volatility, RBI has regularly intervened in the market, and as we speak, they are probably short $60 billion in rupee forward market. There was sharp 4.5% depreciation of rupee in CY25. And because of that depreciation, we believe rupee is likely to remain range bound in CY26. The September GST tax cut and the income tax cut announced in the budget both are impacting revenue, and year to date increase in revenue is just about 2.6%. That's roughly 56% of budgeted estimate. As revenue shortfall happened, government had no option but to increase fiscal deficit. And in the last 5 years, the highest fiscal deficit as a percentage of budgeted estimate is highest at 63%. Now, in the remaining 3 months, net taxes have to increase by about 37% YOY to meet budgetary expectations. This looks a very tall number, and hence we believe the government may cut expenditure, if not retail, then capital, to ensure that fiscal deficit targets are honored. Going forward, Center has committed that they will bring down fiscal deficit as well as debt to GDP ratio to plus or minus 1% over 50% by 2031. That means FY27 fiscal deficit will have to be around 4.2, 4.3, and so on and so forth. The consumption growth is likely to remain resilient, especially with GST tax cuts announced since September. One bad news for India is higher possibility of El Nino. For many years, India has received normal monsoon, but now Pacific Ocean temperatures are increasing, and that creates higher possibility for El Nino, which means there could be below average monsoon. The capacity utilization levels are touching 75%. At this level, normally capex cycle should begin. However, despite pickup in 2026, the corporate capex is stagnating around 11.5 lakh, 12 lakh crore figure. In a country, there are 3 players: government, household, and corporate. And we have seen if corporate India has to do well, 2 out of 3 balance sheets must be in expansion form. Both household and corporate should do well in terms of borrowing and investing, or household and government, or government and corporate. Undoubtedly, Indian households are spending, investing. The government is now trying to lower fiscal deficit. Corporate private investment remains under question. While on one side we are doing everything possible for corporates, private sector to invest, the bank's ability to lend is coming under pressure. The average CD ratio is about 75%. Today, CD ratio is almost at 82%. Whatever money banks generate by way of deposits, they can lend, but with such high CD ratio, their ability to lend also will get restricted. Our thumb rule for economy was GST collection. If GST collection grew faster than nominal GDP growth, then economy is doing well, and vice versa. With September tax cut on GST, it's now difficult to build this model. But for whatever it is worth, the GST collection between April 25 to December 25 has been lower than the nominal GDP growth. But this could be also driven by GST cuts given by the government. Notwithstanding all the challenges, India will remain 1/10 of global economy on purchasing power parity basis. But most importantly, it will be contributing 20% of incremental global growth on a purchasing power parity basis. So clearly, India will remain one of the fastest growing major economy in the days to come. Coming to equity markets, the small and mid cap index both have corrected significantly from the all-time high level, and which has kept investor class fairly unhappy. FPIs have been net sellers in CY25. IT sector was the most sold at almost $8 billion profit booking. On the other hand, FIIs did buy into telecom and chemical sector. The selling by FPI was driven by underperformance of India to peers. Korea up 97%, India up 3%. No price for guessing where people will put their money. Last 6 quarter, corporate earnings growth was in single digit, 8, 7, 4, 6, 9, 2. Undoubtedly, that impacted the behavior of FPI. Thanks to continuous selling, FPI's holding is now at 10-year low at 15.6%. They are underweight India. Last year, emerging market outperformed US, but on a historical basis, emerging markets are cheapest relative to US in last almost 25 years. FPI, while we view them as a single entity, they have different characteristics. We believe this year, primary market participation by FPIs will continue. We also see passive FPIs turning buyers if money starts coming out of America. The selling will continue from HFTs and active FPIs in secondary market, but their intensity will come down. And what is likely to continue on the selling side are private equity players and foreign direct investment disguised as strategic investment. DIIs have been regular buyer in equity thanks to your support. Our hope is that earnings growth will move from about 8-10% in 2026 to about 16% next year. The capex in India is driven more by old economy sectors like energy, utilities, metals, industrials. In case AI investment fails to deliver return, then the world may move from AI exposed sector to AI safe sector, and India could be right in that place where It hasn't invested much in AI, and rest of the investment which is it has done in old economy provides the earnings growth. The market cap to GDP ratio remains at 133%, way above historical average of 87%. But do remember, profit to GDP ratio is also at all-time high level. Valuation wise, small cap is at a premium to its long-term average. Large and mid cap are closer to their fair value. The primary market activity continues to remain strong. There is fair amount of capital raised through IPO, OFS. Not all IPOs are rewarding, but by and large, quality of IPO from a business point of view continues to remain attractive. Overall, if we have to see market, we believe CY26 will be better compared to CY25. Albeit factors like US tariff deal, FPI flows, Indo-Pak tension, geopolitical risks will continue to impact our volatility. Over last 5 years, 300 stocks have doubled from 2020 bottom. 196 stocks are trading today above 50 PE out of BSE 500. And the most important thing of this presentation is this slide. If investors are expecting 20% plus return, they are likely to be disappointed. If they are looking at high single digit, low double digit return, probably that's the realistic expectation. At this point of time, our outlook: be equal weight large and mid cap, be underweight small cap marginally. On the equity on investment side, on a rolling return basis, Kotak mutual fund schemes majority across all time frame is outperforming benchmark indices and adding value to the customer. On a point-to-point return basis, mid-cap, small-cap funds have seen underperformance to benchmark index. We believe we should be able to recover on those two funds, small cap and mid cap. But other than that, across almost all funds, we have delivered better return than benchmark index. SIP, the same story continues. Across most of our funds, most of time period, we have delivered better return than benchmark index, adding value to the investors. Kotak Business Cycle Fund is a flexi cap fund investing across large, mid and small. It focuses on sector rotation. And when the fund moves from one sector to another, it doesn't have to pay tax. Many of the individuals, entity trying to do this will pay tax. The deferment of tax in Kotak Business Cycle makes it ideal long-term investment for investors. Kotak Pioneer Fund is again flexi across large, mid and small. Up to 80% is invested in local stocks and up to 20% can go in global stocks. This fund has consistently delivered alpha, and both Business Cycle and Pioneer can be considered for your portfolio. We are also launching Kotak Services Fund as an NFO on 4th of February. My colleague Rohit Tandon is here. Rohit bhai, you want to run through?
Thank you so much. At its very basic, Kotak Services Fund is a fund which is investing in the backbone of every household. And we will also believe that this is the backbone of India's growth story. Just a few numbers to share. 55% of India's GVA is coming from the services sector, and the service sector growth is above the growth of every other sector through the last decade, 2 decades. 30 more than 30% of the workforce is also part of the services sector. And as per some estimates, 22% of the employment will also happen in this sector. India is among the top 5 countries in terms of services exports. Just to share a fact with you, around 60% of the bank accounts worldwide are run on Indian software. This this growth, the per capita growth should also, next slide please. The per capita growth,
Should I move to the next slide?
yes, next slide please. So, if we are looking at a lot of countries, whether they were developing or whether they were developed, so whether it is China through 2005 to 2024, or whether it is Europe to 2005 to 2024, the share of services has only gone up. So much so that with increasing per capita, the requirement of services only increases. So while one might look at the fact that our services GVA is close to 55% and very close to China, but the point is that with increasing per capita income, the share of services can only increase at an overall GDP level. Next slide, please, sir.
Yes.
What are the services that we are looking at? So we are looking at the basic essential services, for example, logistics, power, energy, telecom, even healthcare. And we are also looking at the services which are in addition to that. For example, media, entertainment, IT, financial services, all of these services. So there is a broad bouquet that we are looking at. And if I might say so, within financial services also, there are different things. For example, you have NBFCs, you have large banks, you have wealth managers, you have asset managers, and you also have rating agencies. So there is a wide bouquet of diversified stocks which is available to you as a part of these large sectors. Next slide, please. So if one is asking or wondering what are the drivers in this fund or what are the macro drivers in this fund, then the first and foremost is the per capita income increase. So, if we look at the last 2 decades, we have moved from a per capita income of less than 50,000 to close to 2 lakhs. As a part of that, our service sector contribution has also moved from 45 to 55. Another way of looking at it is if you look at series of 10 years, then also the service contribution has gone up. So as per capita income increases, people want to consume more and more of services. We are in a phase where we have a youthful demographics, which I will cover in the next slide, please. Next slide. So when we are looking at the population, we are also seeing that the urban population is increasing. Density of urban sectors is much more than those of other places, which means that there is a section of population which is a set of adopters and who are willing to adopt any new innovations, which is a good way of kick-starting services growth. Next slide, please. So as I was talking about the demographics, so as you can see that the number of working population is significantly higher than those of other countries, China, US. And for the next 2+ decades, it will continue to be significantly higher, which means a lot of young people who are earning and they want to experience things. So things like travel, things like entertainment, things like, you know, maybe different kinds of healthcare, all these things, or education, all these things people would be willing to understand and use. Next slide, please. The digital is what is providing size and scale to a lot of services. And it is also ensuring that what the government is trying to spend is also getting monitored. How does that help? That helps in increasing the speed of services. And a lot of things, a lot of services that one would have left out, one can consume now because there are a lot of facilitators which are available. So each of these things are not something that is on the paper and is something which is a vision. It has already been implemented, and we have already seen the advantages of, say, having a UPI or eKYC or a DigiLocker, and we all know that that helps us a lot. Next slide, please. So no, there are essential services, which are bare services, which are required. On top of them, there are additional services. Plus, there is a variant of this service, which is a new economy service. So, from physical tuitions to online tuitions, from physical healthcare to telemedicine, there is an evolution that is happening. And there are more and more such things which are coming to our doorsteps. For example, beauty services at home, or instant payments, services of grocery at your doorstep within 10 to 15 minutes. All these things are coming to us and improving our life and lifestyle. This entire gamut is what we will be trying to address through this fund. Then what is the reason, or what is the value add, or what is the USP of this fund? So as you can see, that the service sector, which has a better, or the service index, which is the red line, has better profitability matrices than the Nifty 50 index, which is also why, because a services sector requires less of capital employed, and it can have much higher EBITDA margins. Next slide, please. If you look at this pie chart, then it shows that services are broadly very diversified, and there are significant options available. As I mentioned before, financial services seems to be a bit higher, but there are quite a few sub-services also where we can invest. So what we are providing is a flexi cap fund, which will have a broad set of sub-sectors linked to services where we can invest. We will be using, from an investment philosophy perspective, the theory of GARP and business management valuations, the combination of which will ensure that we buy a good business, but we don't buy it too expensive. This being the theme of the fund and multi-decade drivers, we believe this is a good product. Thank you.
Thanks, Rohit Bhai. The investment approach in services fund will be flexi cap, of course, backed by bottom-up stock selection. And we look forward to your participation in the services fund NFO. On the passive side, we remain one of the lowest cost passive index ETF provider. Majority of our funds now have lower tracking error. And we also provide thematic and sectoral index ETF. Do consider them as appropriate. These are the recommendation based on our outlook on the market. Coming to fixed income market, Fed is expected to cut 2 to 3 times in calendar year 2025. 26, US inflation remains above Fed's target of 2%, but on the softer side, at just around 3 handle. Despite series of rate cuts in US and Japan, US and increase of interest rates in Japan, the 10-year bonds have started moving up in both the countries. In the case of India, CPI inflation fell below 2%, which was the lower end of RBI's inflation targeting zone. Buoyed by lower inflation, RBI has taken several steps to pump liquidity. And despite RBI's several actions, liquidity by and large has remained in reasonable situation. CY26, we will be looking forward if in this month Bloomberg includes Indian government securities in Bloomberg Global Aggregate Index. If it gets included, we could see inflow of anywhere around $25 billion. In the debt market, we continue to push income plus arbitrage Omni Fund of Fund. In this fund, capital gains will be taxed at 12.5% post 24 months. In our multi-asset allocation fund, we have about 20% exposure to gold and silver. And we also have an interesting product, gold silver fund of fund, where we divide between gold and silver depending upon our outlook on the market. Gold and silver have done exceptionally well last year. We added silver into our multi-asset allocation fund around April 25. Post that, it has a sharp run up. Gold, we were bullish since COVID, except 2021 when gold delivered negative return. Rest of the year, this call has worked out well. The real support for gold is coming from the fact that it is mining constrained. Just about 23% of the gold is, or the discovered gold is mineable. Central banks have been buying golds of almost 1,000 tons every year since last 4 years. Despite that buying, emerging market economies' allocation to gold remains well below developed economies' central bankers' allocation to gold. We think emerging market economies will continue to buy gold. The silver has also witnessed a super cycle, partly driven by industrial demand from electric vehicle and solar photovoltaic cell. It is also getting supported by rumored buying of central banks around the world. From a demand supply point of view, since 2021, the supply seems restricted against emerging demand from solar cell, investment, and electric vehicle industry. Almost half of silver's demand comes from industry side. The automotive industry is likely to move from ICE to electric vehicle, and that should continue to support silver demand. There are rumors of Saudi and Russian central bank buying silver through front organization. The biggest impact in this market is China, and many a times they don't disclose their true buying and selling. Many people believe in CY25 their buying was substantially higher than what was reported. China also continues to take policy action to support or impact precious metal prices.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.